Hello and welcome back to the channel. Now this is going to be part 3 of the Endgame series, Monetary Arms Race. So in the previous 2 episodes we explored where we came from and the sequence of events that led to this huge debt bubble being built up in our economy. And in the previous video we explored what the transition from this period of getting rid of this debt bubble into a more sustainable system will look like, and that is going through the fourth turning. And in this video, we're going to explore how the competing forms of money are going to be attempting to get through the fourth turning and survive into the next saeculum. So before we get into it today, guys, don't forget to like and subscribe, and also to turn on notifications so that you don't miss Endgame Part 4. So really, in this monetary arms race, there are 3 main factions. The first is the dollar and the dollar derivatives, and this also includes all Western currencies, because all Western currencies really follow the dollar, and any decision that the Fed makes, these Western countries and currencies will follow. The second is the BRICS faction, so that is the global geopolitical power that is attempting to directly challenge the dollar hegemony. And the third is cryptocurrency and the decentralized forms of money that promise to take money out of the control of institutions and put it back into the control of the free market. So to quickly recap, how did things get so bad? I want to read this quote by Ben Bernanke when he was addressing Milton Friedman and Anna Schwartz. "Let me end my talk by abusing slightly my status as an official representative of the Federal Reserve. I would like to say to Milton and Anna, regarding the Great Depression, you're right, we did it. We are very sorry. But thanks to you, we won't do it again." And I think this quote really sums up the mentality that the Fed has had for really the past 40 years, that they must avoid another recession and another deflationary event like the Great Depression. And they have done anything and everything possible to avoid that deflationary event. But through taking those actions, the unintended consequence is that there is a huge amount of debt that has been built up in America and in Western economies and in many Eastern economies. And this is a big part of the fourth turning, that these old monetary institutions like the Fed and like the dollar are very likely to fall and are likely to lose their power in favor of the new institutions and competitors that are coming along. However, they won't go easily, and they will not easily give up this power and this exorbitant privilege that having the world reserve currency gives you. So again, going back and recapping the death of the dollar, basically, the debt-based economies that we live in now are all an illusion. If you are lending in the dollar by holding either fiat or bonds, then you are lending to an entity that can never pay you back. Would you go and lend $10,000 to a homeless man on the street? I suspect for most of you, probably not, because there is that expectation that you will not be getting that money back. Well, that homeless man has far more money than the United States government has. And globally, worldwide, there is around $300 trillion in bonds that is essentially insolvent. This money will never be paid back. So, a huge pool of wealth and energy and resources currently sitting in bonds and quite possibly unaware that it will never be getting paid back and is insolvent. And this will become very relevant in the next video. And so this leads us on to the monetary arms race, because America needs others to hold the dollar and for demand for the dollar and for debt denominated in dollars to stay high. And the traditional way that everybody knows and everybody thinks that governments do this and the Federal Reserve does this is to raise interest rates and make it more lucrative to save in the dollar and also more lucrative to lend money. However, in the current environment, you can't raise rates for too long because of the massive debt burden. If you look at Japan, they have had essentially a 0% interest rate for the past 30 years because they are the most indebted society at 250% debt to GDP. So any interest rate raised by the Bank of Japan causes the Japanese national debt to start growing exponentially. And America is in a very similar situation, not quite as bad yet, but not far off. And so they have to find other ways to keep demand for the dollar and keep people holding the dollar and holding debt denominated in dollars. And so why does the Fed actually want and need to keep the dollar demand strong? The reason the Fed needs this is because it needs to essentially rug pull those who hold dollars and hold dollar denominated debt in order to pay the national debt and for the Treasury and government to pay their debts. Because one way to lower the debt is to cause inflation, because the debt falls in relation to the rise in GDP that comes from inflation. So the overall debt to GDP ratio falls. And inflation and inflating away the debt becomes a lot easier when lots of people are holding fiat and debt, because essentially there is a bigger pool of wealth and of energy to be able to extract from. So basically, they are getting you to hold the debt, and then they are defaulting on the debt. They are getting you to lend them money, and then they are defaulting on paying that debt back. Not nominally, they will still pay you, but they make the value of that debt and the value of those dollars less. And essentially, this is trickery, right? It's a financial and economic sleight of hand. And so how do they actually get people to hold debt and fiat without raising rates? Well, first of all, they do it by trickery and coercion, and then it becomes slightly more sinister with them beginning to use force. So the Treasury, the Fed, and the government are going to need to team up in order to accomplish the goal of reducing the debt. Because currently, the Federal Reserve is hiking rates, trying to slow down borrowing and trying to slow down inflation, whereas the government is borrowing more and more in order to fund its expenditures and also pay the interest on the current debt that it has. So currently, the Federal Reserve and the government are at odds with each other. They have different goals and are trying to steer the ship in different directions. And for them to be able to achieve their goal of reducing this debt, they are going to have to team up. And this happened in World War II, when the Treasury issued a huge amount of war bonds to pay for World War II, and the Fed helped them do that by capping interest rates at a low level, and essentially gave the Treasury a whole load of cheap debt. And so in a system and in an environment where you can't really use high interest rates to keep demand for the dollar, they need to use other means and other methods. And in this system and in this environment, financial repression is the name of the game. And financial repression is described as measures by which the government channel funds from the private sector to themselves as a form of debt reduction. So basically, it is a means of extracting and taking wealth from the private sector, in other words, you, in order to pay the national debt that it has. And there are various ways that they achieve this, from coercion to deception to outright violence. And so we're going to have a look now at some methods that governments use to do this. And this is taken from a paper called The Liquidation of Government Debt. So yield curve control is kind of the first stage that governments will start using. So yield curve control basically targets specific interest rates across different bond maturities. So essentially what this means is that central banks will buy and bid bonds issued by the Treasury in order to keep interest rates suppressed. And so they suppress these interest rates, making government debt cheaper to finance at the expense of savers and lenders' returns. And for those who don't know, when the price of a bond goes up, the yield of a bond goes down. And when the price of a bond goes down, the yield of that bond goes up. So basically what the Fed does is they bid the bonds and keep the price of the bonds high, thereby keeping the yield of the bonds low. They will also try and create a captive market to direct capital from the private sector to the public sector. So what this looks like is a home bias in the investment portfolios of financial institutions and individuals. So for example, banks are required to hold a significant portion of their deposits as reserves with the central bank. And they will give sort of liquidity reasons for this, making sure that banks have enough reserves to cover the deposits. But really, the name of the game is getting them to hold government debt. And regulations mandate that financial institutions, especially domestic ones like pension funds and like insurance companies, also hold a substantial amount of government debt in their portfolios. And this one is particularly insidious because the vast majority of people who have a pension really have no idea what is going on. And so by governments mandating that these pension funds hold a significant proportion of their assets as government debt, and then the government is essentially defaulting on this debt and not ever paying it back as it was originally valued, the government is essentially directing funds from pensioners in order to pay off the national debt. And this one is more of a deception-based method, and I call it the CPI instead of CPI, with CPI standing for Consumer Price Index. And basically the CPI is the common inflation measure of an economy. And basically there are constant revisions in how inflation is actually calculated. So as you can see on the graph there on the right, the current measure of CPI is that red line there, and it stays relatively flat around that 2% mark. But then the method that inflation used to be measured by in the 1980s, as per that method, inflation is much higher, averaging around 8 to 10% per year. And the way that they do this is essentially the basket of goods that they use to measure the rise in prices becomes lower and lower quality over time. And part of the reason for this is because that as prices rise, people change their spending habits in order to try and offset the rise in prices. So, for example, if you have a big burst of inflation and something like prime steak becomes very expensive all of a sudden, then a lot of people are going to switch from buying prime steak and instead buy cheaper ground beef, because it's much easier to keep the cost of ground beef lower by putting lower quality ingredients in it. And so therefore what they will do, because the consumer is buying less prime steak and buying more ground beef, they will take the prime steak out of the CPI basket and put the ground beef into it, thereby concealing the actual true rate of CPI and the true rate of price rises. And so when you look at things that are very scarce and very difficult to lower in quality or make more of, for example, something like waterfront property or fine art, they will follow the rate of M2 growth as their rate of price rises very closely. So they follow the true rate of inflation. Whereas these lower quality goods that can actually be lowered in quality, like ground beef, they can be used to mask the true rate of inflation that is going on. And so raising the tax burden can also help. However, it can also be a double-edged sword. And the reason for this is because that if you raise the tax burden too much, then you can take out too much money from the economy and actually start to lower the rate of GDP growth and even potentially cause a recession. And so that lowered rate of GDP growth means that the debt to GDP ratio stays high because the GDP part of the equation is not rising. And so the UK is using a form of fiscal drag, essentially as a stealth tax hike. And what this means is that in a highly inflationary environment like the one that we have just been in, they will freeze the numbers on things like tax bands. So for example, the income tax threshold in the UK is £12,500 and it's going to stay this way until 2028. But of course, £12,500 2 years ago and £12,500 in 2028 are very different. And so because they have frozen these tax bands, a large amount of people are being dragged into the higher tax brackets, because people's wages are naturally going up with the rise in inflation. And wealth taxes on equities can also be used by governments to make government debt more attractive and more lucrative, because if there are high amounts of taxes on equities but no tax burdens on government debt, then it can convince people that government debt is a better investment than equities are. And now we start to get to the slightly more oppressive forms of financial repression. For example, capital controls. So capital controls is essentially where you stop wealth in one way or another from leaving the country. And that means that you're not allowed to make foreign investment and that you're not allowed to open foreign bank accounts. And now this is harder to do in the US due to the relatively strong rule of law compared to the other countries that the US has, but it is not impossible. And this starts to really become a proof of force game, where you now start to use the threat of violence and essentially of imprisonment in order to keep demand for the dollar. And so this brings us to Executive Order 6102. So in 1933, the US government made it illegal for any person or entity to hold physical gold. And this was punishable by 10 years in prison. Now, so they were essentially banning the private ownership of gold, and this was rarely enforced at an individual level. More often than not, the government went after, big institutions such as banks and bullion dealers, which had large amounts and large deposits of gold at the time. And this was rarely enforced at an individual level. And I've highlighted this because this is very important, and it will come up later in this video. But however, there were cases of individual prosecutions and essentially kidnapping by the state just for holding physical gold. And this became quite a lot more sinister in 1934 with the Gold Reserve Act, because basically all of this gold that the US government took from individuals and from institutions, they did pay them and they gave them paper claims on the gold of $20.67 per ounce. And now these claims were non-redeemable, but they did at least have a certificate for that gold. But then in 1933, the value of the gold was revised from $20 to $35 an ounce. So this gold that they have just forcibly taken from citizens and given them $20 for is now valued at $35. And so they have essentially confiscated the gold, gave everybody who held that gold dollars, and then all of a sudden cut in half the value of the dollar when compared to gold. So this is really getting higher up on the oppressive level of financial repression. And, many people say that this sort of thing couldn't happen again. But you have to remember that this is the fourth turning. And the last time this happened, it was the last fourth turning that America was going through. And the same political and the same economic conditions led to Executive Order 6102. And there are steps by the EU who want to build a comprehensive database of all the assets that all citizens own. Because if they know exactly what everybody owns, then it becomes easier to confiscate and easier to do the same thing that America did in 1933. And the last one I want to touch on is something called moral suasion. So moral suasion is essentially a financial strategy where central banks or government authorities use persuasion rather than legislation to influence the behaviours and decisions of financial institutions. And basically, this generally involves appealing to the sense of duty or patriotism, saying that they are supporting their country and they are acting patriotically by either holding debt or fiat. So basically, what you are doing is you are shaming those who wish to exit the current system. And it's not just US citizens that are affected by this. The US public hold around 2/3 of the government debt, with the other third being held by foreign holders, and that includes other central banks and other foreign financial institutions. But the thing is that these foreign central banks and foreign financial institutions also don't particularly want to be holding this debt the government is then defaulting on by inflating away the currency. So they also want to get away from holding this debt. And it's much harder for the government to use financial repression on foreign holders and foreign institutions. So, for example, China has been lowering the bond purchase of US debt and instead buying gold. And when this happens, the buyer of last resort has to step in, and the buyer of last resort is the Federal Reserve, which means that when the Treasury issues new debt, there will always be a buyer, but sometimes that buyer is having to use newly issued money in order to buy the debt. And so when other nations are buying the new debt that the Treasury is issuing, it has much less of an inflationary effect. But when the Fed has to step in and buy the debt, that is bad because the monetary base goes up, which causes inflation. And inflation makes owning government debt less lucrative, which then slows the amount of national and international buying of that debt, risking entering a negative feedback loop. And so here you can see the federal debt held by foreign and international investors. And really, since 2015, the amount of federal debt held by foreign institutions is slowing down and is growing nowhere near at the same rate that the US national debt is rising. So you can see the red line, which here depicts the total amount of government debt held by foreign holders as a percentage has been decreasing really since 2013, meaning that the Federal Reserve is having to step in and act as the buyer of last resort and buy this debt. And the seizing of Russian assets has also played into this monetary arms race, because sovereign nations see that the US assets that they hold in the form of treasuries and US dollars are basically subject to them behaving in a way that appeases the US. And that money and that wealth is not really theirs. It is only theirs if the US allows them to have it. And it is very much not a permissionless form of money. Them having that money is very much dependent on them appeasing the US, which makes these treasuries and US dollars much less lucrative to hold and much riskier for these international institutions and governments to hold. So really, by doing that, the US has shot themselves in the foot in the long term, and it was a very short-sighted and short-term strategy. And so rising as the direct contender for that world reserve currency status and the direct contender to the dollars are the BRICS nations. And the BRICS nations are made up of Brazil, India, China, Russia, and South Africa. However, while this is a serious threat to the dollar, and really the first real threat to the dollar since 1971, it is unlikely that the BRICS nations can create a currency that becomes the world reserve currency. And there are a number of reasons for this, because the rule of law is relatively weak in a lot of these countries, meaning that you don't particularly want to hold an asset which is issued by a country which has corrupt institutions. Now, to try and counter this, they are suggesting that this currency be backed by gold. But, this is very unlikely to happen because this would essentially run into the same problem that the US had in 1971. And these countries would have to become net importers of goods due to Triffin's dilemma. And, these countries, especially China, rely on being net exporters in order to sustain strong economies. And net importing would eventually lead to the same problems. Basically, eventually they would run out of gold. And the fact that there are 5 different sovereign nations within BRICS means that there is no unilateralism within the organization, and that these different countries may want to enact different economic policies. And in order to have a world reserve currency, you really do need to have that one overarching decision maker that is able to do what they want. And so likely the path that these 2 factions will go down are central bank digital currencies. And central bank digital currencies massively aid governments in enacting financial repression on their civilians because they allow for mass surveillance with them knowing everything about your asset. It also allows for social credit. So, for example, if you are a good citizen that supports the state and always follows the rules, then you get access to sort of cheap debt and cheap credit and low interest rates. Whereas someone that doesn't follow the rules and doesn't support the state, well, they would have much higher interest rates. And also control of exchange. You could actually stop someone from exchanging the central bank digital currency, again, if they have spoken out against your regime. And you can sort of blacklist the wallets of that person that's spoken out against your regime. So once again, central bank digital currencies essentially rely on proof of force. However, more than likely, they will try and push central bank digital currencies onto the population. So basically, what is your only option here? Because this debt is insolvent, it will never be paid back by the government. However, they will do their best to make you pay it back. But, as a 26-year-old who didn't really have anything to do with the building of this debt bubble and hasn't really benefited from the building of this bubble, I basically opt out. This was your bed, you lay in it. I refuse to bail them out, and I reject any moral suasion, for example, the EAG narrative. And so basically, your only option is that you have to flee fiat. You have to get out of the pound, the dollar, the euro, any form of fiat. Never lend in any sort of fiat. Never buy or hold bonds or any government debt. And then on the flip side, you actually want to take out as much debt as possible and put it into real assets and into hard money, as long as you can stay solvent. And if you do own any cryptocurrency, you always want to self-custody it. And again, this will become important later in the video. So in the previous videos, we had a look at the assets versus the balance sheet. But, if you do need to exit and you choose to exit and you refuse to bail out the government debt, then where are you going to go? Well, there are only 2 things that are outperforming the Fed balance sheet. Tech is outperforming because it is bringing real productivity growth, and crypto is outperforming because it is the adoption of a new monetary system. So this is tech versus the Fed balance sheet, and it has essentially only just recovered since 2008. But overall, it is a slight uptrend against the Fed balance sheet. However, when you compare this to cryptocurrency against the Fed balance sheet, well, cryptocurrency against the Fed balance sheet since 2014 is up 18,000%. And so if you measure technology against crypto, then it is absolutely collapsing, and it is down 99% against cryptocurrency. So really, it's pretty simple, If you want to beat the debasement, you can either own technology or crypto, and technology is down 99% against crypto. And the invention of cryptocurrency has thrown some serious complications to this round of financial repression. Bitcoin is like putting a magnet in an MRI room. It's almost impossible for the old system to survive now that you have introduced this new asset. Wealth is fleeing the dollar, and now that you have a global, divisible, portable, and unseizable asset, basically now you truly have the option to opt out. And as more capital leaves, the dollar weakens more, which causes more capital to leave, and it essentially becomes a death spiral for the dollar. And those who exit earlier will do better, and those who exit last will do the worst. And Bitcoin really has given you that option to opt out of paying back that huge amount of debt that was built up that likely you had nothing to do with. So really, it should not be your responsibility to pay back. So, for the first time, we truly have the option to opt out, and we have an exit strategy. And, Bitcoin against the Fed balance sheet is absolutely dominating, and it is still rising exponentially. However, there is just one issue. And that issue is the scalability of Bitcoin. Bitcoin can only handle, on the base layer, 7 transactions per second, whereas, for example, something like Visa handles 24,000 transactions per second. And the base layer of Bitcoin only has enough data for 10 bytes per person per year. Even with astronomical fees on the base layer, this is not enough to bring freedom from fiat slavery to the masses. So what is the solution to this? The solution is to leave the base layer and go on to layer 2s. And so now we are going to have a look at some layer 2 solutions that are being proposed in order to solve the scalability issue of Bitcoin. And this graphic is from someone called Jordan McKinney, so full credit to him. And I will actually link one of his videos in the description of this video, because he has a look at the Lightning Network and the Liquid Network, which are both Bitcoin layer 2s, and goes into why they are very unlikely to work, which I am going to try and summarize here. So basically, the Lightning Network operates as a layer 2. So a fee is paid on the base layer to open a channel. And so that is from A here, this node here has a channel to this node here. And channel transactions happen off chain, so are very cheap and very fast, with A being able to send Bitcoin to this node here for very low cost and very quickly. And eventually that channel is closed and the Bitcoin is settled and distributed on the base layer, and it goes back down to the base layer. And payments can also route through entities. So for example, A here could send Bitcoin to B by going through this node here, and then going all the way to B. However, routing is limited by the channel balances. So for example, if A wants to send 1 Bitcoin to B, but this node here only has 0.5 Bitcoin, then A will not be able to send that 1 Bitcoin to B, because this node here only has 0.5 Bitcoin, and so is not able to send that 1 Bitcoin to this node and then on to B. And there are also a few other small issues, such as liveness attacks, where both nodes are basically signing to agree a transaction, but then one node can try and attempt to close on the Bitcoin base layer with a earlier transaction and not the final transaction settlement, which means that both nodes have to be online at all time. And also, if the transaction history is lost by any one node, such as A, then A basically has to hope that this node here that they have been transacting with and settling with has that full transaction history, and that they are also honest and willing to share that transaction history. But those are relatively minor issues compared to the main issues. And basically, the main issues is that the current scalability of Bitcoin, in order to onboard the entire 7.9 billion people on Earth, it would take 50.1 years to onboard everyone. And in this hyper-Bitcoinization world, transaction fees in order to open a channel on the Lightning Network would be around $1,000. So, say that you open and close 1 channel per year, that would cost you $2,000 per year in order to be able to transact, which for the vast majority of people is not realistic. And so basically, the only practical way to achieve mainstream adoption is with custodial services, basically banks. Because in order to solve both these routing issues that the nodes have, and also to solve the issue of getting everybody onto the layer 2 in the first place, and the huge amount of time and money that would cost to achieve, custodial hubs, or in other words, banks, can pool this Bitcoin in order to have both a high liquidity requirements for the routing, and in order to get those people who are unable to afford to open their own channel onto the layer 2s. And so this is what that would look like, with these smaller dots being the individuals who are trading claims on Bitcoin, and then the Bitcoin being held by these large hubs or entities, otherwise known as Bitcoin banks. And then those Bitcoin banks are able to transact with the Bitcoin base layer. But basically, hubs are a form of centralization. Hubs will be hit with both know your customer and financial regulation. Hubs are Bitcoin banks. And the only way to know how many claims a hub has on their Bitcoin is to physically audit their books, because there is no connection to the base chain. And, really, how is this any different to the current system that we have? This system, due to game theory and due to these hubs and banks wanting to attract customers, would be forced to create paper Bitcoin and to essentially break the 21 million hard cap that Bitcoin has. This would lead to very similar problems that we have in our current financial situation. It wouldn't be exactly the same and it wouldn't look exactly the same, but it would look very similar. And the liquid network is also another solution. And the liquid network essentially is a side chain. So you send Bitcoin to a multi-signature wallet where 15 validators sign into a multi-sig and keep the Bitcoin in that wallet. And then you essentially trade a completely different asset on the side chain that is liquid. And in order to unlock this Bitcoin in the multi-signature wallet, 11 validator signatures are needed. But how are 11 validators supposed to stand up to the powerful institutions that exist? If another executive order 6102 came about instead for Bitcoin, are these 11 validators going to be able to stand up to them, or are they more likely to just hand over your Bitcoin? And, this is essentially proof of authority. This is even worse than proof of stake. These validators have no skin in the game. They have no stake. And, bearing in mind that we are going through a fourth turning, and this financial repression is going to get far worse before it gets better. It is not inconceivable that governments and large institutions come after Bitcoin as a form of financial repression. So what does the future of Bitcoin look like? Are you going to be legally obligated to keep assets in a Lightning channel? Are you going to be legally obligated to use government approved and regulated channels? For example, in Turkey, Bitcoin is illegal to use as a payment for goods. Europe is talking about making self-custody illegal. However, this won't even be a problem for the vast majority of people because no one will be able to afford self-custody. Know your customer requirements will be universal. More than likely, you will be legally obligated to use a government-approved and regulated liquid sidechain. And so basically, Bitcoin has become completely institutionalized. And remember how enforcement becomes much easier at that institutional level, again with Executive Order 6102. So Bitcoin is becoming centralized on these layer 2s, and it is becoming a custodial solution on these layer 2s. And I predict that if these layer 2s ever do actually take off and gain more adoption, then a Bitcoin central bank is basically less than 2 decades away. And why would this time be different? Human nature has not changed since we left the Horn of Africa, never mind since the use of banking and central banking. And the game theory and the incentives of these centralized structures on the layer 2s dictates that obfuscation and rehypothecation will need to be used by Bitcoin banks to stay competitive. And so really, how is this system going to be any different to the current system that we already have? And under this system, will Bitcoin allow you to escape the debt slavery that is being forced upon you by these centralized institutions and by the financial repression? Are you going to be able to be truly self-sovereign with the Bitcoin standard? And so there are a few other proof of work projects, such as Bitcoin Cash and Litecoin, that are also proposing to be that opportunity for self-sovereignty and to escape that debt slavery that is being forced upon you. But Bitcoin Cash trades off on node decentralization in order to achieve scalability. So, these little nodes here that are numerous and really anyone can run, these will no longer be able to operate on a Bitcoin Cash system. And so you will have these large centralized node institutions. Again, and institutional nodes with huge data centers provide a point of centralization and an attack vector for financial repression. And Litecoin has security trade-offs and has a lower than 51% security threshold. And the reason for this is because blocks are made at a faster rate, there are more blocks floating around the different nodes and basically more unconfirmed blocks within all the nodes. And so for an attacker to coordinate an attack, they have to create less than 50% of the blocks in a system which requires less than 51% of hashing power. And there are many proof of stake systems out there that are also trying to bring self-sovereignty and this escape from debt slavery. But proof of stake essentially is the same as shareholder voting. The share of the network determines your voting power, and Pareto's principle dictates that wealth always trends to a small number of people. And this essentially becomes centralization of voting power and is essentially the same as the centralization of nodes. And this is very similar going back to a system in Britain where only the aristocracy and the hyper rich were able to vote and nobody else was able to vote in that system. So then again, only the hyper rich and those who own a large stake of the network will be able to be truly self-sovereign. And this is the proof of stake attack vector. And it becomes especially sinister when a proof of stake project has a pre-mine and has pre-allocated coins to venture capital or insiders. So basically, all of these assets have attack vectors. All of them are able to be controlled and coerced in one way or another. They are exploitable and they can either be stopped or co-opted and taken over and controlled. And, what is the common theme? What is the common weak link? The human is the weak link, and any form of centralized power within one of these projects or within one of these assets make the human the weak link, because the human can either be targeted or they can become greedy. And if something is exploitable, then it is guaranteed that it will be exploited. There will always be those looking to exploit that system for their own gain. So, if only there was an asset that's proof of work and backed by the laws of physics, no third parties ever need to be used, and the base layer can scale to Visa level transactions. Self-custody and self-sovereignty is available for all. A truly peer-to-peer system instead of a custodian-to-custodian system. A system that is fair launched, has no venture capital, no pre-mine, is 100% open source, and nodes can be run on $100 hardware with no central governance. Well, there is an asset like that, and that asset is Kaspa. And Kaspa is the first project that has solved the blockchain trilemma and achieved scalability, decentralization, and security. Now, this video is already going to be long enough, so I'm not going to go into how Kaspa works in this video, but I am going to be linking one of my videos where I do explain that in the description if you are interested, and I do highly recommend you watch that to try and get a better understanding of how Kaspa solves the trilemma. And the thing is with Kaspa works because of human greed. Kaspa aligns with human nature, just as the Bitcoin base layer does. However, proof of stake and Bitcoin layer 2s, and also low security projects, they will fail because of human nature. Kaspa removes the weakest link, which is the human, or any form of centralized power within that system. It is decentralized in every single aspect. And there's this great quote by William Shakespeare, which goes, "If you prick us, do we not bleed? If you tickle us, do we not laugh? If you poison us, do we not die? And if you wrong us, shall we not revenge?" And I would like to add another line to this quote. If your asset is exploitable, shall we not exploit it? It is human nature to want to be able to do that and to want to gain power within that system. And Kaspa, because it is scalable on the base layer, follows natural law and aligns with natural law. And it is based upon principles and truths that are inherent to creation and aligns with the laws of nature and the laws of physics. And it works because of human nature and human greed. Whereas Bitcoin layer 2s follow man's law. They are based upon dogmatic beliefs and constructions of the mind. And regulations will differ based on location and also based on time. And the strength of your self-sovereignty on these layers is only there and is only safe if there are not entities trying to gain power and trying to gain control over money, which you can almost guarantee at any point throughout history, throughout the past or in the future, there will always be those entities. If a system's design does not account for human nature and human greed, then it is a bad design. We can criticize the Federal Reserve all we want, but they are only operating within the current system. We can criticize the government for financial repression all we want, but again, they are only operating within the current system. And both of these flawed systems basically do not account for human nature, and they allow for the exploitation of money because of their bad design, as does the Bitcoin layer 2s. Whereas Kaspa is a system that accounts for human nature. Kaspa works because of human nature and because of human greed. And because Kaspa is wholly decentralized in every single aspect, there are essentially no attack vectors other than the individual, which is vastly more difficult to control than institutions are. And so Executive Order 6102 would be impossible under a Kaspa standard. Kaspa is the incorruptible version of the truth. It is a living network that is spreading and growing stronger every single day. And the idea of Kaspa and being the trilemma solver and being that money that truly offers self-sovereignty to everybody, well, that is an idea that is growing more and more and cannot be stopped. Like stones rolling down hills, their ideas reach their objectives despite all obstacles and barriers. It may be possible to speed or hinder them, but it is impossible to stop them. Now that Kaspa has been unleashed on the world, and it truly offers freedom to everyone, it is an idea that cannot be stopped. Kaspa is the end game. Kaspa is the asset that brings freedom from debt slavery to the masses. Kaspa allows every single person to opt out of the fiat Ponzi scheme that is currently going on. And the not your keys, not your Kaspa adage is a reality for everyone, whereas the not your keys, not your Bitcoin will only be applicable for a very select few. And, so Kaspa is the asset that truly can bring an end to the Fed and to the current fiat system and can truly get us through this fourth turning and move into a first turning, which will be better and fairer for everybody. And so, I suspect this has been a long video by now. So what does all of this mean? What are the actual consequences of this? Well, it means that if you use Bitcoin as your medium of exchange, then you are at a real world disadvantage. You are able to be controlled and your assets rehypothecated and essentially stolen. And you have to remember that the monetary technology that gives the greatest number of people the greatest advantage to hold and to adopt will become the money. It will win the monetary arms race. And this is because a monetary network is a network of individuals all acting in their own self-interest in accordance with human nature and in accordance with natural law. And so, this will play out differently in the short term versus the long term. There's this concept of antifragility, where a system grows and gets stronger from a period of crisis. And so Kaspa is anti-fragile. Kaspa will become stronger in all of these environments, and a period of crisis will actually likely gain strength to Kaspa because all other assets put you at a disadvantage to hold, which we will talk about more in the next video. Whereas Bitcoin on layer 2s will become weaker and more corrupt and more exploited in a period of crisis. And this is because the attack vectors that exist are more likely to be exploited in the time of crisis when the government is trying to use as much financial repression as possible. And so, this begs the question, is there space for both? Is there space for both Kaspa and for Bitcoin? My opinion on this is that medium of exchange and store of value are inextricably linked. What we want to use as our store of value, we also want to use as our medium of exchange. Something that is a medium of exchange and no store of value at all is something like a Facebook message or an email. Something that is a store of value and no medium of exchange is something like a ton of gold on a desert island. It has value stored within it, but there is no way to release that value or release that energy into the environment. So next video, we are going to go through two different models. The first model is going to be the digital silver model. So this will be a model where Bitcoin essentially is acting as sovereign collateral and as a store of value for the ultra wealthy, whereas Kaspa is going to be acting as the medium of exchange and the store of value for the masses. It's going to be kind of a bi-cryptic standard that we are living under. And so we are going to be looking at how high Kaspa could go in this scenario, assuming that Kaspa is able to capture the vast majority of that medium of exchange market as the layer 2s are exploitable. And then we are also going to be looking at the superior monetary technology model. And this is going to be operating under the assumption that money is a winner takes all market. And so Kaspa manages to capture the entire money market and take the lion's share of the monetary premium from the traditional financial system. This is going to be the model where Kaspa becomes the global reserve currency and the most liquid and saleable good. So we are going to be looking at how high Kaspa could go in that scenario. So thank you guys very much for watching. Again, don't forget to like and subscribe and make sure to turn on notifications so that you don't miss the next video. But other than that, thank you very much for watching, and until next time, cheers.